This is Signal Points for the week of February 15, 2026. I'm Travis Zeiler. Here are 5 current signal points I'm watching across Bay Area multifamily as transaction activity begins to reawaken in the first quarter of 2026. Starting with number 1. Transaction activity is beginning to thaw, but only for stabilized or clearly underwritten assets. After 2 years of muted sales volume, recent regional data shows multifamily transaction counts modestly increasing quarter over quarter, though still well below pre-2022 levels. What's notable is not broad-based recovery, but the selectivity this has been demonstrating. Well-located, operationally stable assets are clearing, but anything with messy financials or deferred capital risk is still struggling to trade. Liquidity is returning, but discipline hasn't left. Number 2. Despite recent Fed rate cuts, Bay Area multifamily cap rates have not meaningfully compressed. Most Class B and C trades in core submarkets are still clearing in the mid-5% to low 6% range, depending on quality and rent control exposure. That tells us something important. Buyers are underwriting long-term operating risk and legislative uncertainty more heavily than short-term debt cost improvements. Lower rates alone are not resetting valuations. Number 3. Rent growth has been stabilizing in most Bay Area submarkets, but it's not accelerating meaningfully. Year-over-year effective rent growth in much of San Francisco remains in the low single digits. This represents a recovery from negative territory, but far from the double-digit surge years. Absorption is improving, but concessions remain present in competitive submarkets. In other words, fundamentals are normalizing, but they are not overheating. Number 4. Operator focus has shifted from aggressive revenue growth to disciplined cost containment. Expense growth, with regards to insurance and utilities particularly, continues to outpace rent growth in many portfolios. As a result, asset managers are spending more time analyzing controllable operating expenses and vendor contracts than chasing marginal rent increases. Operational discipline is driving returns more than rent optimism. And number 5. Hold period assumptions are quietly extending. More acquisition models are projecting 7 to 10-year holds rather than 5-year value-add flips. With refinancing markets still selective and exit cap rate assumptions cautious, investors are underwriting patience. That shift changes how capital planning, reserves, and renovation pacing are structured from day one. Taken together, these signals point to a Bay Area multifamily market that's not speculative, but it has been stabilizing. Capital is returning carefully, and execution discipline remains the differentiator. The cycle so far in 2026 may not be booming, but it is clearly recalibrating. That's this week's Signal Points. I'll see you again next week.